Well, hello and welcome to the ProVest Perspective. I'm Noel Swain, CFP, and I'm happy to have with me as a guest Peyton Hoppus, who is in our office. And today we're going to be talking about some alternatives. We're going to be talking about some alternative ways to retire, because retirement is what this company is all about, and there's more than one way to do it, right?
That's exactly right.
Excuse me. Right, Peyton?
That's exactly right. Yeah. So Gabe and I have talked before about families and planning, but we're planning for retirement. The end of the goal is to retire at some level or pay off debt and take it easier in your working years, like some kind of planning format. But we're all getting ready for a day in which we don't have to work as hard or as much, and so
or at all.
So if we're in a stage of life where 50 or 45 and we're getting those kids through the last bit of their school years, and then we're jumping over into retirement, it may look different. I mean, everybody's situation is different. Some people say I'll work a little bit forever. Some people say I'm done at 65. Don't call me again. So
I've known people that were 60 years old and haven't worked in years.
Yeah.
And then I know people like me.
Yeah.
Who does who just don't know how to quit.
Yeah. I think that's a good way to put it. Well, today we're going to go through the 5 kind of typical ways. Well, they're not really typical, but 5 ways that we have seen people retire or work through retirement, and they're atypical or not typical, or they're in your boat or not. And so, if you're listening to us on the radio, you're listening to us somewhere on a podcast, you can't see it. Visuals are great. You can always check out the podcast. That'll be up later. But in the short term, we're going to talk about kind of what the retirement history has looked like. If we think about traditional retirement style, pretty much to 65, and then you retire and you don't work again, or some age and then you're done.
Retirement, Peyton, hadn't always been with us.
Yeah.
Retirement is only about 100 years old, the concept of retirement.
Yep.
Used to, people, they grew up, they went to work, and they never stopped until they died. Of course, they only lived to be like 42 years old. But that was a long, we've been thinking about retirement, and we're doing retirement planning like it's been around forever, but it really hasn't.
Yeah.
I know that the concept of retirement wasn't even thought up by old people that wanted to retire.
Right.
It was thought up by factory managers who wanted to replace their old slow workers with some young, fast workers. And so they didn't know how to go about doing it, because old people, they hadn't saved any money. They didn't know what they were doing. And so they just kept on working because they didn't have any way of taking care of themselves.
Right.
And so that's when in like 1885, one of the companies, I think it was Dow Corning, came up with a retirement plan. And they started retiring some of their older workers, because they were paying them $25 a month or something to live, and it didn't take that much to live, of course. Back then. And they were able to replace their older workers with younger people that would then start working and be able to get old, and then
but they're more productive at youth, and they're a little bit cheaper to hire, and they don't have to deal with all the health stuff, maybe call outs as they get older in life. So I mean, it's a productivity measurement, and then
it kept on, and we had like 75% of the national non-farm workforce that had pensions at one time.
Yeah, that's right.
And now the pensions have dwindled, but what we did started with Franklin Roosevelt was Social Security.
Yes.
And everybody has Social Security now, and nobody doesn't want to go without it.
That's right. What was the first Social Security check? The dollar amount.
Yeah, I think I've seen the picture of the first check that was delivered to the first recipient. I can't remember her name right now, but it was for $23. That was the first Social Security check, and it's been going up. And my, my mother-in-law, who is 87, and her husband retired. She didn't work after she had some medical issues, but when she was in her early 30s.
Yeah.
But $1,200. I think she gets $1,500 a month now.
Wow.
And people are retiring now with Social Security checks in the $3,500, $4,000.
Yeah, we've seen that for sure for high income earners, and that's a can of worms because people are going to have questions on Social Security, and
And they do, and we answer questions all the time.
Yeah.
I know you get some questions about it, and it's important for us to know what we're talking about when it comes to Social Security.
Yeah, we've got some stuff we solved for folks, but when it comes to planning out the retirement, the typical style is work till age 62, 60, 62, 65, 70, 72. Typically people pick in their mind
until it got to Social Security,
and then they start pulling it.
Yeah. And then once their Social Security turns on, they retire and they get a little pension, or they draw from savings, and they retire.
Yep.
And that's the way that's the traditional way to retire. Now, back in 1983 is when Tip O'Neill and Ronald Reagan got together, and they fixed Social Security by slowly raising the age for retirement.
That's right.
Because it was at 65 for so many years, from the 1930s until the 1980s, and they started raising it from 65, and then they raised it to 66, and then 66, and 2 months, 4 months, 6 months, 8 months, 10 months, and then 67.
Right.
Anybody born in 1960 or later, their full retirement age is 67 now. And so a lot of people that are born, they don't, they had no idea that it was ever 65.
Yeah.
And that's why Medicare started at age 65, but they never changed that.
Oh, right.
They never changed that. So it's still at 65. And of course, Medicare is in trouble, financial trouble because of that.
Yeah.
And so you see all these politicians say Medicare for all. They have no idea what they're talking about unless they really want to run Medicare out of money so much faster than they're doing, or they want to collect so much more in taxes.
Yeah. Which neither we like the result.
No, we don't want it either one to happen. Yeah. So it's just Social Security is there, and the way it is right now, it's going to run out, and it's going to run out in 2033 or 34, just simply because we're going to run out of money, and the people that are collecting Social Security, they'll only get about 75% of what they're getting now. If something doesn't change, I can tell you something will change.
Something's going to give.
The politicians are going to fix it, because if there's a group that votes, it's old people.
That's right.
And if you want to get voted out of office, do something that has to do with Social Security
or Medicare,
and mess up Social Security for these people, and you will be out of a job.
That's right. So we've extrapolated Social Security, which is a big piece of why the retirement age exists and how or where we're at as far as the numbers. People ask, why is my retirement age 67 or full retirement age 70 or 72? I think my generation is.
Well, full retirement age is still 67 right now.
Well, I guess
more than likely they will be changing. They will be upping it. However, if you don't take Social Security at age, if you don't take Social Security at age 67, and you decide not to take it, then if you wait till 68, you get an 8% increase. 69, another 8%. 70, another 8%. So you can get an extra 24% in your Social Security income. You can get that without, if you don't take Social Security at 67.
Yep.
And of course, if you take it as young as 62, then you lose 30%. And it's not I've had people say, well, I'm just going to take it at 62, and then I'm going to stop it at 67 and start it again and be normal. I said, no, you don't get to do that.
Once you start, that's it.
Once you start, that is the end, unless you stop within a year and pay it back.
That's right. So you can get out of it, but once 2 years into retirement,
once you're in it,
you're done.
That's it.
Yeah.
And the thing of it is, what if you take it early and you get that discount?
Yeah.
And then your spouse didn't take it early, and they waited till 70 to take it, and all of a sudden, they pass away, and you step up to their Social Security, you still have to take that discount. That discount still applies. And so in my own situation, my wife never accumulated enough quarters. You know, you got to have 10 quarters of pay. No, excuse me, 40 quarters of pay. You got to have 40 quarters. And she never got that many. So, so without that, she's going to be relying on my Social Security. But if she takes Social Security early, she's 65 now. If she takes Social Security early before 67, and then I die later on,
she's stuck at that number.
Then she still has to take the reduced amount for the rest of her life.
Correct.
So I'm having her wait until 67.
So it's a
to get hers.
Yeah. So this gives us a good picture on Social Security, Medicare, why we have been built the way we've been built as a society, on retirement. The traditional retirement that we're looking at, these 5 types, is work from whenever, 18 at least, was kind of the thinking, but into your 20s out of college or out of high school at 18, and you work till 65. You save, you invest, the pensions aren't there, but the concept of retirement has stemmed from just before the turn of the 19th century, when we started saying, okay, we're going to start giving folks some benefits so they can get out. We can replace them with something.
Well, you know, what came along in 1978 was the 401k plan.
Yeah.
You know, we had the IRA starting in, I think, 1975. But what happened in 1978, they started a 401k plan because companies were tired of being on the hook for everybody's retirement.
Right.
And if they invested badly, then the companies had to make up the difference.
They're liable, right?
And they did not want that liability.
Yep.
So they started getting rid of pension plans. That's why Congress came in and started the 401k. Now, why do they call it a 401k? Because that's a section in the IRS code that where you'll find it. But anyway, the 401k started, and that makes the investor, that makes the employee, makes him responsible for his own retirement. If he wants to invest it in stocks and bonds, he can do that. If he wants to invest it in just the guaranteed interest contract, the GIC, then he's able to do that. He can do it in any way he wants, but he's responsible for the results.
Yes, and that's where a lot of our work comes in now. Helping manage that, and whether it's IRAs, brokerage account, a Roth account, 401k. And people ask, okay, what's the difference between a 401k and a 403b? I'll mention this because you brought up the IRS code. I said the 401k is a for-profit line, or it's the IRS code for a for-profit company. The 403b is the IRS code for a nonprofit company.
And they've had 403bs for ever.
As long as they pretty much had 401k. So
I think they came over on the Mayflower.
That's right. People think those are usually different, but because they've been here since the Mayflower, they're the same concept as a 401k, just for like a hospital or a nonprofit.
Right. Well, I've always known it with basically, you know, the biggest group of public employees I know of are teachers.
Yeah, that's right.
School teachers.
Yeah, that could be a school system.
And we've always had 403bs.
That's right. And now they've got a state plan, the pension or the people plan, they've got different classes and the way they're set up. That's a little bit kind of got that pension feel to it, because that's basically what they structuring of it, but then they offer a 403b with.
State employees do have a pension.
Yeah.
They still have a lot of government employees still have pensions. They never got rid of them. It was the
for-profit. It
was the individual companies that were out trying to make a profit that got rid of it. You know, if a company doesn't have to make a profit, like a school or a police department, then they don't have any reason to want to get rid of the pension, and that's how they operate.
Well, we define pretty well what retirement is, how it's operated, why it's existed, and I know we're gonna take a break on our segment here. We're going to come back. When we do, we're going to start talking about 4 other types of retirement, how people approach that. Some are more common, some are not very common. And it's really about the psychological adjustment of how you want to retire. That's really what we're getting into in the next segment.
And our job is to make sure that people are able to retire the way that they want to.
That's right. So
that's important across the board. I mean, there's nobody says, I want to be forced to retire at this particular age.
Yeah.
They want to do it the way they want to do it, and that's our job to help them do it that way.
That's right. Well, we'll jump into that section then, and we'll rock and roll with financial independence and sabbaticals and talk through what those look like.
All right.
So the next section here is going deeper into what is financial independence. And a lot of people have different definitions of maybe what that means to them. And then we were going to talk about sabbaticals. Sabbaticals are a little unique. I have a lot of pastor friends that will have these after a period of time. So it's probably a unique sector to talk about style wise.
And some companies, for-profit companies, do the same thing. They allow their workers. I know I have a son-in-law who just spent a month in Indonesia. They're doing a project, doing some work at an orphanage and stuff, and
Very cool.
And he's back at work now and doing well. But he just had a sabbatical,
Yeah.
and so they can, sabbaticals are something that not very many companies or for-profit companies at least allow.
Yeah.
But they are, but it's the way that some people like doing it. And most people that take sabbaticals do work for some type of an entity that is nonprofit.
Yeah, and it does work well. So the visual we have, you're looking with us on our podcast, but if you're looking at it here, we're going to talk through it. The sabbatical, they've kind of structured it where it's every 5 years they take up a chunk of time. On here, it's kind of hard to see, but I know a lot of pastors that I have every 5 years or 3 years, especially if they founded a church, they'll take a sabbatical where they get the summer off. So for the whole summer, they can, they're still getting paid, but they're having people preach for them. And then when people
that happened at the church I go to.
Yeah,
the pastor takes every July off.
Yeah, that's exactly right.
When he came back a week or so ago, he said he came back when he ran out of money.
Yeah, that's right. That's a good way to operate, right? But the one that's probably the most there's a couple on here that are great, but one that's number 2 for us is financial independence. A lot of people, I have some examples of this. I have a unique one in the sense that I talked to some guys. I said, how hard do you want to work and when do you want to retire? And 2 clients specifically, one said, okay, we're in insurance. We're starting a new firm. It's going to take some years, but I've got 20 years to get to 55. I would love to at 55 say, hey, I can just pull what it is, whatever the income is from the firm as an owner, and coast. But up until then, I need to do everything as if that's not going to happen. But when I get there, I'm still invest and save. But the kids will be in college or they're out, and we want to travel. So I want to maybe work 35 hours a week instead of 40, or 30 hours a week instead of 40, or something, where I'm working 3 days a week and take some time off.
But the financial independence side of it is where they get to the point to where they can step away from their job.
Yeah.
Permanently.
Yes.
And they just have the financial independence to retire before the normal age.
That's correct.
That's what financial independence.
Yeah.
I think what you're talking about is more of a time where they what I've come to term phase retirement.
Yeah. And
phase retirement is where you might not be doing the work that you were doing before, the high stress, high level work that you were doing before. But you're not working as many hours.
Right. So in our number 5 down here, semi-retirement, we'll get to that one in a minute because it's exactly what you're describing. But I asked him, I said, so do you want to work at 55? He said, no, I want to continue to work. However, I just want to say if I can step away, then I can step away, but I'm still going to go work. I'm just the type of guy I'm going to work. I said, okay, then you guys, so I did a plan for him and we do investments for him. I said, you need to save 30 grand a year to be successful by 65. And there's some debt repayment we're working on, but invest 30, pay off 10 grand a year extra in debt. Okay, that's 40 grand. So let's assume that debt's gone and you've built up a nest egg. So you never have to take on car debt or anything else, student loan debt, anything we're working through in short term. I said, but at 55, if you want to do that, you need to be making 200 grand a year at the same cost of living you're paying right now. And then you need to put 50 grand away. Okay. So at 150 grand, put 30 grand away. At 200 grand, put 50 grand away. And there's a strategy around debt and where we put the money on what buckets. And at 55, if you want to walk away, you can. Now, you're not going to, but if you want to sell it and go do something else, you always work. You've told me that. And his wife doesn't work at the time, and they've got 2 little kids. And so that's the plan we created. So on the flip side of that, another client of mine is a physician. And I said, okay, when do you want to retire? And he said, well, the guys I work with, they are going out and getting it. And they're pushing their workload higher and higher to, a point that they can sustain, but it's higher than mine by a lot. He said, so their energy level is going to be, their goal is to make probably 100 grand more than me or 150 or 200 if they can every year to retire by 55. That's their goal. So that is the one we're talking about. Boom, financial independence, 55. And then from there on, you let your savings and investments maintain your lifestyle. I said, okay, well, what do you want to do? He said, well, that amount of energy to get to 55, if I work what I'm working now and do the math, it's the same energy if you just work to 65 and then retire. He said, so I'm targeting 65 traditional retirement style and be done with it. He said, however, along the way, I would love to know at some point I could walk away, but I'm okay working till 65 or 62 or 67. He said, I'm not going to work myself to death and then out and burn myself out. I said, okay.
And the good thing about that is that we have the program that can tell people that's what
you can do if you do X,
what percentage chance do you have of making it the way that you want it to be?
That's right. So I got clients who are both ambitious, both making great money, just want to do it different ways. And they both got 2 kids and a wife. And so they're like, I'm okay working to 65. The other one says, I'm okay to work. I want to work to 65 or 70, but they both want to get to a point where they can be financially independent around 55. One of them's willing to work harder to get there. And then from there on, no, he's good, but he wants to work. The other one's saying, I'll take that same amount of energy and I'll just stretch it over, next 30 years instead of shortening it up by 10 years. And, but I'm okay to do all the X, Y, Z, pay off debt, invest this. So he was similar. Okay, you guys need to pay off 10 grand. And theirs was actually 8,500 in extra debt just for a period of time. And they're going to get out of debt. The house paid off, everything for X amount of years. And then beyond that, you need to invest about 35,000 and you're good by 55. But, everybody's expenses and incomes are different. So that's 2 ways we've seen financial independence work, and they're building for it. However, both of them are okay working longer.
Yes.
And so I do have guys who are hardcore. 50, 58, I'm not working anymore. My dad worked to 62 and died. I don't want to do that. So, everybody's got their rhyme or reason.
Many people that have seen their father work to the bone and then die early.
Yes.
And you're right, they just don't want to do that.
That's right.
And our job is to help them not do that.
And somebody asked me today, Peyton, who do you focus on? And I talked about it. And I said, well, I'm more interested in working with someone who wants to find a purpose with their life, and we can figure out what the number is to get whatever they're trying to get out of life. But so this sabbatical one is kind of a unique one in the way I think about it, that I want to tell people, like, you should enjoy taking some vacation. Work hard, put it away, but you should enjoy more breaks than what you're getting. Right. Now, I know if you're strapped and they'll give you 2 or 3 weeks a year to, vacation, I get that. But people who are business owners or people who have flexed their schedule, I say, what if you just work 7 days on and 7 days off for a period of time? All right. And then you go back to a traditional 4 or 5 days a week. Like, what if you just did that? That could be sabbatical style, because at some point those 7 days turn into 14 days because of the way it works. And I said, so look, sometimes we got to work through your financial plan and build that. That's a good way to do it. You think so? 7 on, 7 off? You will come in here on Sundays and be slaving away?
That's what I'm thinking about that.
That's a great idea.
I don't know. My inbox will fill up so much.
It'd be empty for 7 days.
7 days trying to work through the inbox.
It's a little bit of a struggle to balance that out. Yeah, the inbox is the worst part sometimes. But yeah, so we want to help people figure out how to work. And if you have to work a little longer, but you take some sabbaticals or you take longer stretches of time where maybe the income's not as strong, but you can do it for a longer period of time because you enjoy what you do, you should be taking some time off. No, Gabe and I'll tell you, you should be taking strategic time off so you can get a break, and that you've worked your career to do this, and we're here to help the process phase out easy for you. But the point is, like, there is going to come a cadence where that makes the most sense. And there's that word again I've used 100 times probably today alone. But yeah, you want to build a rhythm. And I think that it is healthy. Our American style is work yourself to death, neglect your family, be more productive, make more money. And it's like, but I'm making money and killing myself for what? If I'm neglecting my family or hobbies or something. So,
and that's something I've never done. I've always worked hard, but when it came time to go to my son's games or his concerts or whatever, I was always there. And I don't think it's good for any father to not be there for their kids.
Yeah.
I was lucky to be able to do that, to be able to set my own schedule.
Yeah. So again, whether that is...
And you're in the same position. You got 3 kids.
Yeah.
And
a lot of recitals.
So you got a lot of recitals to go to.
A lot of baseball or softball or whatever they're going to play. We don't know what they're going to do yet, but when they get there, that is the goal, to have flexibility to be there for those things, and excited to do it. But that just sometimes means I go at 4 o'clock for a recital, and then I hit the inbox or the email or the projects I'm doing at 7 to 8 before I go to bed, or at 7 to 9.
Or before or after the kids go to bed.
That's what I'm saying. They go to bed at 7:30. I just work a little longer at night. So again, maybe your sabbatical is day to day and you structure your day different. Maybe it's you take every Friday off when you hit, 50 years old or something, if it's possible.
But the bottom line is our job is to help you be able to take that sabbatical.
That's right.
Plan that out.
That's right.
Make sure it works.
That's right. I have clients that'll have a bonus because of production. And so they'll work till they know they're going to get their bonus and then say, okay, I don't need to work every Friday from now on. If that's a physician, that's a good example. But I have some buddies who are dentists and lawyers, and they do the same thing. Okay, if I work extra, I'm not getting any benefit other than a little bigger paycheck. So I'm going to take the last 4 Fridays of this quarter off. I've hit my quota, right? And so again, I think what our job is to do is guide you through what's financially, wise. And somebody, you've said it before, people come in with wealth. Our goal is to help you maintain that wealth and continue to grow it, but you build it with your own cash flow. We want to help you plan on where you should put the money to obtain what you're trying to chase.
And that brings up a question. I've had many people come to me and said, well, I don't think I have enough money to work with you.
Yeah.
And the way I look at it is what you have is your fortune.
Yeah.
And we're always going to try to treat it that way.
That's right. That's right. Well, we're gonna at the next kind of interval here, we're gonna talk about coast fire, which we're going to talk about what that means in a second, and semi-retirement, which we hit on earlier, which a lot of guys and gals are kind of shifting to. Really, these are the two main ones I'm seeing a lot of people talk about. So when we come back, we'll chat a bit on that, and after the break, we'll talk, some examples there as well.
All right, sounds good. We'll be right back.
All right, folks. So we're back. Next section. You're here with ProVest. I'm with Noel Swain, CFP and founder of ProVest. My name's Peyton Hoppus, and I'm an advisor here. And we're working through the 5 types of retirement. How people retire is different. Everybody's got a rhyme or reason. Everybody
has it. Everybody's, what is it? You're unique just like everybody else.
That's right. That's a great way to put it. So everybody's got their style of retirement and how they want to do it. And everybody's got a different goal timing wise with that. So, what we're looking at visually here, if you can see what we're showing, is maybe different numbers, and maybe your numbers or ages are a little different than what's on the graph. But the point is, the next 2 kind of types of retirement we're going to be talking about is post-fire. We'll talk about what that means, and semi-retirement. We hit on this earlier. So let me define coast-fire for those just listening. And if you're visually looking at it, it kind of makes sense. You work hard and you get after it for the majority of your career and working years, and you stuff the money away. So think this is kind of like, Dave Ramsey's pretty famous for saying beans and rice and beans if you need to pay off debt. And this, it's semi that in the mindset that every dollar I've got is going to go somewhere to solve something. I'm not going to have any extra fluff. I'm not going to let spending get away. A lot of people that do this coast fire, what FIRE stands for again is financial independence, retire early, is they're going to put a target date. This is 50 in this example, where they get to a point by 50. If they do the calculation right, by the time they turn 65 in their traditional retirement thought process, they don't have to put away as much money, and they can enjoy from 50 to 65 a little bit differently than the average bear because they work from 20 to 50.
What would they have to have done by age 50?
Yeah, so that type of individual is not taking on debt. They're paying their house off early. They're cash flowing everything they can. Now sometimes life happens and we have a medical bill. That's, technical debt, and we just pay on that. But they're paying their debt off aggressively. They're investing into the right buckets accordingly every single month. It's staying consistent. And they're not necessarily trying to time the market. They're just putting time in the market, which is the best results they can get. But a lot of people think of us and just think, put my money in there, make it work, and I'll have enough. But at home, what these folks are doing for the Coast Fire camp is they're paying debt down and making sure the house and everything is taken care of. That way, when they have low expenses going into retirement or as close as they can get to retirement, and they're stuffing away usually somewhere in that 40 to 50% of their income into investments. That's typically what I've seen for the guys and gals that want to do this. They're 35, 40.
So they are eating rice and beans.
They are pretty much eating PB&J's, rice and beans, maybe an occasional orange juice here or there, but mostly water, right? Drinking coffee in the morning and no creamer. So these folks, it just takes a certain type of person, but that's not a problem. Their mindset typically is we want to enjoy 50 to 65 in our years where we can still move and groove and bend over and run.
So what you're saying is they can slow down as far as what they're putting away.
A little bit.
And they can coast a little bit where they don't have to have the high pressure, high pay job.
That's right.
They can make a little bit less.
That's correct.
And because they put away enough early in their life, and what that will do is it will parlay into a larger sum and be enough at the time they fully retire, so they can live on that. Is that correct?
That's correct. And we're going to see something here shortly. I know you're going to be able to probably explain it pretty well, but it's understanding what you need at 65 or whatever age you're targeting, and then back it up to an age in which you want to get there. And then you need to get to $1 million. That way by 65, it's $2 million. And then I've got enough to retire. But they are then maybe changing jobs. Maybe they go from the corporate job until 50, and then they go and say, hey, I'm going to start my own farm. I just need to make 80 grand a year, no savings. I just need to make 80 grand gross, and then that'll get me there because my nest egg, I've already packed it for the past 10 years.
Well, I've heard you can make a small fortune in farming.
Yeah.
You just have to start with a large fortune.
Yeah, that's right. Somebody told me one time, they said, you know how you become a millionaire by racing? I said, no, how do you do it? Go drag racing? He said, well, you start with $3 million, you go drag racing, you end up with $1 million. You're now just a millionaire.
That's right.
And I said, well, that's a pretty good way to put that. So that's kind of the concept, right? So that's coast fire. You get to a point where your investments, you can coast on how much you put away. Or, you know, my earlier example where you put 50 grand away instead of 30 to be successful by 55, maybe you put 60. But then when you get 50, you don't put but 10,000 away or something different, right? It's a dramatic change in your lifestyle.
Right.
Because you've already built it up until that point, whatever that age is.
You know, I've known so many people that said, you know, they worked hard in the corporate world and they want to slack off and teach.
Yeah.
And I've never understood that because teaching is hard.
Yes. Yeah. But I think they mean, because there's still a workload there, but I guess they're talking about they don't want to have to be pressured to sell and they can enjoy the people and the kids. And I can understand that. But so semi-retirement, now this is one that we kind of hit on earlier where you work to a certain point and you say, hey, I'm going to dial it back. I'm not going to work 5 days a week, or I'm not going to work.
You put enough money away.
That's right.
You don't need to you don't want to take any money out yet. You want to let it continue to grow, but you just make enough money to pay your bills.
Yep.
While you're working those last 10 years.
That's right.
You don't need anything. You know, it may be that you're able to turn on your Social Security. It may be that you've got a pension from another job that you have, and it starts at that point. So you don't need to make quite as much money. So you go to your employer and you say, hey, I've been thinking, you know, could I work 20 hours a week? And could I work in this job that's not quite so high pressure? And that's what, and I've done several radio shows on this before. We call it phased retirement.
There you go.
Where you phase into retirement, where you're not retiring, you know, you're not waking up one Monday morning with nowhere to go.
Yeah.
You know, you still have somewhere to go, but you don't have to go at 7 o'clock. You can go at 10 o'clock.
Yeah.
And you don't work quite as many hours.
Your spouse probably enjoys that a little more than you being at home all of a sudden for the next 10 hours if you both retire the same day. Right?
I think mine would, but I'm not sure.
So phase, we're phasing you then again. Yeah. So phase retirement and semi-retired. My dad has actually been in this camp for a while. He runs his own business, and so for about since about 55-ish. He has had a semi-retirement where he will work pretty hard to make the money when it's available, but at the same time, he can just keep the faucet dripping and on. But then when something comes in, he opens it wide up when he wants to, and then turns it right back to where he needs to go. So he's addressing it, letting it build income, and then like kind of letting that 20-hour work week work for him.
And that's what phase retirement is all about. Now, if you have your own business and you have a staff that can pretty much run things without you, that's the best way to do it.
That's right. And again, that's a business owner, but some people can do that at their job, especially if they get credentialed. You know, again, some people I know that are in the medical world, they say, I'm going to work 3 days a week as a consultant, right? When they get out of doing what they're doing, or an OT or PT.
I've known so many people that went into consulting.
Yeah. They can work their own hours. So that's the 5 types of retirement we work through. Everybody's got a different timetable. So whether you phase at 60 to 70 or 55 to 65, or you have a coast fire career where you try and hammer it down till 45 or 48, and then you retire officially at 70. I mean, everybody can have a flex on what this is. It's just examples. If you're looking at the visual, it's just numbers to look at. But conceptually, it's you quit cold turkey, or there's a bunch of other options in how you get there. But the planning process is what we enjoy to help you understand. Okay, you can phase tire starting at 57. Well, you can't really do it by 55. Why don't we do it at 57 or 60? Right. So we can give you numbers when we plan.
That's right, and that's what the software that we use is all about.
Yes,
because it can give you, well, at 55 you've got a 60% chance of reaching your goals.
That's right.
If you work another 2 years, that 60% goes up to 80%.
That's right. Yeah, because you've paid off debt, you're socking it away. You know, so we can show examples of what's possible. And again, it's hard to look 30 years out for people who may be 35, but we can at least say, hey, these are your options. If you want to get here by 55, do X, Y, and Z, or here by 40, do X, Y, and Z.
That's right.
So we can kind of break it down to micro segments, 5-year increments, and we can see how that impacts us by the next 30 years.
Absolutely.
So we're going to kind of roll into the next section here. which is annual cost of retirement and retirement savings. And we're going to briefly talk on these visuals on the slide. We're going to go pretty much to the last slide, which is where a lot of people have the conversation of how much can I pull from what I've got. But depending on what state you're in, that matters a lot. Now, there's averages on here based on the average retirement spending plus 20% comfort bonus. This visual from Visual Capital says that in South Carolina, it would take 68 grand a year. That's net, probably net of what your actual taxes are, to be able to retire at some level in the state. Again, no savings,
normal,
just normal life.
Is that correct?
That's what it's saying. That's
$68,000 a year.
Yep, cost 68 grand a year to retire, to maintain. Now, again, that's a general number. I mean, the lower part of the state could be higher. You could be somewhere near Augusta, and it's a different number, or you could be in Greenwood, and that's a different style. So I think the numbers, depending on where you're at, obviously can fluctuate. I can tell you right now, I wish my core cost for $68,000 a year for me to. But with 3 kids, they eat a lot of Cheerios, so I think I'm just spending that.
Well, they're talking about retirement, so those kids are not going to be kids anymore.
I know it's hard to see it when they're sucking all the dollars up in Kit Kats and Cheerios.
All we got to do is to save $5,000 and move to Georgia.
Yeah, there's 63,000 in Georgia. That's right. move 50 miles and you save $5 grand, folks.
That's right.
But the other slide on this, or other visual on the slide is retirement savings and by age. So under 35, it breaks it down kind of in 10-year increments: 35 to 44, 45 to 54, 55 to 64, 65 to 74, and then all families. Gives you an average of what retirement savings by what age are, and then what the median number is. So if you're under 35, the average retirement savings is about 50 grand. And then as we go up every year, every 10 years, if you're below 44 but above 35, it's 142,000 saved for retirement.
Is this what people have saved, or is this?
That's the average. That's the
average of what they have saved.
Yes, sir.
Or what's this number?
The median. So the median is 45,000, right in the middle. But the average,
what people have, as much as 100.
Well, 142,000 average means there's somebody above that, somebody below that. But right in the middle, where the probably the most people in the data set is 45,000. So the most. I guess the most amount of people that have $45,000 are between 35 and 44. But the average number is higher than that, just based on the data set. And again, I don't have that in front of me. But the point is, if you're in the bracket of 45 to 55, and we're not playing the comparison game because that's a thief, but the average person's a family, I would argue this is a by age, but somewhere in the family category, has $300,000 to $315,000 saved for retirement. And then as you go up, that number is about 538,000 at 55 to 64, and 65 to 74. The average person in the U.S. has 600 grand saved in retirement. And then above that, it kind of categorizes all families. If you aggregate that all together, that's 330 grand in average saved dollars for retirement amongst all those categories. So if you're in the 55 range and you have about $500,000, we're going to go to the next slide because that kind of determines what you can do. So let's say that $500,000 by the time you're 65, and you're 55 now, turns into $1 million. So on this slide and on this scale, what we're looking at, we have $1 million, and we go all the way up to $6.25 million. And this is talking about how much money you can pull with a 4% rate. The 4% rule is a very popular rule, but it's not one size fits all. But when we have people come in asking questions, and you and I were talking earlier, they'll say, okay,
we have people talking. I've been texting recently with we're not texting, but emailing recently with a client, and he's saying this is what he's going to have. How should he go about? What will it provide him in income? And I'm saying using the financial planning standard of 4%. And I've seen videos lately that said never go by the 4% rule. Well, what are you going to do?
You got to start somewhere.
So yes, you have to do that. But somebody says, well, I'm going to have about $2 million when I retire. How much will that get me in income that should sustain itself over my entire lifetime?
Right.
Well, it's going to be about $80,000.
Yeah.
You can, or let's just say somebody comes in and says, okay, I want to retire, and I want to retire with $100,000. How much money or $100,000 of income?
Yeah, that's right. How
much money do I need to have saved to be able to provide me that $100,000? I said, does the $100,000 include Social Security?
Yeah.
Does it include any pensions?
Yeah.
But let's just say that, it's $100,000 beyond Social Security and any pensions. Well, in that case, we need $2.5 million.
Yeah.
Well, how close are you to $2.5 million? Well, I'm a little bit away from that. I've got $150 saved. I said, well, you're going to have to speed that up a little bit.
Yeah, right.
But it's that's the thing that a lot of people just don't. I've had people that retired with $100,000 and thought it would last them the rest of their life.
Yeah, yeah.
And that's why we do what we do.
That's right.
We want for people to understand what they need to do. And the thing of it is, everybody's going to have to put money away.
That's right.
Now, when I was little, I had no idea what compound interest was.
Right.
I had no idea that you could make money on money.
Yeah.
What I thought is whatever you put away is what you had.
That's right.
And then when you used it, used it up, that was it.
Yeah.
I didn't know that I think Benjamin Franklin, to paraphrase what Benjamin Franklin said, he said, money makes money, and the money makes more money. and so that really does work, and that's the compound interest. I think Einstein said compound interest is the eighth wonder of the world.
Yeah.
And so what we try to do is help people understand that compound interest. But the faster we can get it to compound,
right,
the better off you are. And that's one of the reasons that we talk about the investments that we use.
That's right.
Because we want to make sure that that when we're talking to clients about how they save, where the money goes, what are the ideas, the best way to invest it.
Yeah.
We want to make sure that they understand that too, because what they don't understand is if they save a certain amount of money out of their paycheck, then the better rate of return that they get from that money that they save either means they'll have more money when they get to retirement, or they can retire a little sooner because they'll get to their goal faster. Yeah. And that's what we try to do with our clients. And that's why a chart like this is so important. Yeah,
it's a great visual. It's a great understander. And, there's a rule of 72. Basically, whatever your average return is that you've been having over the past X amount of years, average, get your average number. You divide 72 by that number, and it tells you how fast your money would double. And so,
how many years it takes?
How many years it would take? Yeah. Yes, excuse me, I said it wrong. Would double. So if you're in 10% average, it would take you 7.2 years to double that pot of money. So you get $500,000 at 55. Mm-hmm. It takes you, 7.5 years. You got 10 years of retirement. In theory, it should double and then some by the time you get to 65.
I started in this business when I was about your age. Yeah. And I was doing seminars. Yeah. And that was part of every seminar. That was always the beginning part of every seminar.
Explain it.
Was to do the rule of 72 because people don't think exponentially. They think in linear terms. Yeah. And so they think 1 becomes 2, becomes 3, becomes 4. They didn't know that 1 becomes 2, becomes 4, becomes 8.
That's right.
And that's the difference between learning the rule of 72 and not knowing it.
Yeah, and when you see it play out, it's a different ballgame. I mean, you feel it, you see it, you touch it. It's fun to watch clients get an aha moment and go, oh my gosh, we've been working together for 5 years. And from most of my clients, they're putting away money, but I've got a bunch of clients who it's still growing pretty well, and they've pulled out some RMDs and they're pulling out a little money here and there. And we've done well to plan around what they need, but it still grows. And like, man, I wasn't sure it's going to make it, but we're up double since we started working together, let's say 5 years ago or something like that. And they're excited about what they now can do, and they take grandkids out. So if they understand what's possible, and we work with them on planning, and we work with them through the investments, and they see it come to fruition, that takes a couple of years to kind of get those results to start coming in, and you get to understand it. That's, for me, the fun of it, where everybody gets to see the big picture. Because I got into this industry because I felt like, okay, I got to make sure you, Mr. Client or Mr. Person, need to know at least what's out there, right? I don't want to just assume you know what's going on. So let me help educate, but also execute. And so we want to plan for success, and we want to lead excellently in how we invest. And that's the main focus, is make sure we plan ahead. And when we get to the investment part, we also have an equal opportunity to do really well for you. And that's our goal. We want to make sure we hold you through to retirement on that.
Well, to give you an idea about that, and this is something I've never really talked about. Back in 1996, and it's a long time ago, we're talking 30 years ago, I was given an award, and the award was 20 shares of a brand new mutual fund.
Oh, that's right.
Selling for $10 a share.
Yeah.
So I got a $200 prize. You know what that value is today of those original 20 shares that have grown because of dividends and everything?
I bet you it's a big number, Noel.
It's over $7,000.
Right. Oh, we started with 200. You didn't touch
$200
it.
30 years ago.
30 years, yeah.
And you don't touch it. You don't think about it. You just let it. You let the professionals manage it. And has it gone down in value some at times? Oh my. Has it?
Oh my.
It has. If I was looking at it and it was and if it had been $200,000, I'd have probably wet my pants when I saw some of the things sometimes. But letting it go, it has really moved over the years and done well. Yes, it's done poorly at times, but it always comes back.
Yeah.
This is one thing I've heard people talk on the radio saying, the stock market, take one step forward and two steps back. Sometimes it seems that way.
Right.
Sometimes it does seem that way.
That's right.
But when I first started in this business in 1984, you know where the Dow was? It was right around 1,200.
Yeah.
You know where it is now? It's 54,000.
Right. That's like two steps back to me.
Yeah. And that doesn't, it sounds like a step or half a step back every now and then. And it does do that. But it always takes off. And you know how many times the stock market hasn't recovered from a big downturn? You know how many times it hasn't recovered?
I'm going to guess it's a low number.
Yeah.
Zero.
Because it has always come back.
Yeah.
There's never been a time that the stock market did not come back.
Now, it might take 7 years to come back in certain sectors or metals or oil. Like there's times where parts of the market or the economy, but the market takes time to come back.
Overall.
No, that's what I'm saying. It may take, people see it pull that back and go up. In recent years, it's been very quick recoveries. But there's been times where there's been in the 70s where we had some long periods of time where it just didn't do a lot of anything. And then it did come back.
There were magazine covers that said stock market is dead.
Yeah.
They just didn't know.
Yeah, that's right.
And that's why it's so important. That's why I still have such a passion for what I do here. And, at 76, I still have that passion.
Right.
I still love to see people when they have that aha moment you were talking about, and they say, "Hey, this can really work for me."
That's right.
And that's what I love to see.
Well, we're excited. We're glad everybody tuned in if you're listening to us. Again, this is ProVest Wealth Advisors, Noel Swain, CFP, throwing out his experience, throwing and flexing on us what his experience has been and how he does things. My name's Peyton Hoppus. We've enjoyed talking with you. We've enjoyed walking you through retirement styles and different data points and different things that you can think about, examples. And at the end of the day, folks, if you have questions on your finances and you want a financial plan, you want to talk investment strategy, and you want to get a big picture and bird's eye view for some experience in the room, we're happy to do that. And so we've enjoyed today. I've enjoyed it, Noel. Have you?
Oh yeah, this has been a lot of fun.
Yeah.
Can't wait to do it again.
That's right. We'll be back on it soon.
That's right. It's great seeing you, and we look forward to talking to you again next time.